Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 11th of July, 2022. Alright everyone, let's get into it. So I hope you all had a great weekend. I personally spent some time away from, like crypto generally and crypto Twitter generally over the weekend. It was weird actually. For the last 2 to 3 days, I spent most of it not doing crypto stuff. I still kind of like paid attention here and there, still was on Twitter a little bit, but again, I kind of like came back to it tonight to get ready for the refuel, and I was like, wow, okay, a lot happened while I was kind of like offline here that I kind of like didn't really get to see because I was just kind of like spending more time offline. So that was different, something different, I guess. Like probably best to do that sort of stuff in a bear market where, you know, there are still things you're going to miss, but it's not like a bull market where you have to kind of like be online because you're getting FOMO, right? And you're going crazy and being like, oh my God, I need to know what's happening, blah, 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 right? So I spent a bit of time just playing some games. I played games called Little Nightmares 1 and 2. It's kind of like a puzzle platformer game. Two of them. They're not that long, but they were pretty enjoyable. I really, really liked it. I like that style of game. And I built my friend a new PC. So definitely stuff that was still on a computer or like around computers, but definitely not really crypto related. So that was kind of like refreshing there. But anyway, now I'm back into it. I'm very excited to go through the updates from the weekend today. So let's get started with Tim Byko's first update here, which was a recap of the AllCoreDevs call that happened Friday night. Now, this was not the one where they discussed the Girly testnet date. That will be in 2 weeks' time on July 21st. And I've kind of like talked about that on last week's refuels. So when that AllCoreDevs call happens, we'll get a girly date, and then after that, we'll obviously get mainnet date for the merge. But I've been through all that already, so no need for me to rehash that here. But if you do want to read Tim's kind of like recap thread of what happened on Friday's call, you can. It'll be linked in the YouTube description below. I think what they really discussed was Grey Glacier, which was obviously the fork to push back the difficulty bomb, and then the Sepolia testnet merge that also happened. It went kind of like smoothly as I discussed last week, and then a few other kind of like things here and there. But as I said, I don't think they talked about Girly. We felt like we may be able to pick there's an actually update here on Girly. They're saying we felt like we may be able to pick the TTD for Girly either next week during the consensus layer call or the week after during AllCoreDevs call. Okay, so it's either going to happen on the consensus layer call, which is a separate call to the AllCoreDevs call, which will happen next week. Next week actually being this week, or the AllCoreDevs call, which I think is next Thursday. So one of the two will get a TTD for Girly, which will obviously dictate the date. I'm still expecting early to mid-August for Girly. Maybe if it happens this week, the TTD or the date, it'll be early August. If it kind of like happens next week, maybe it'll be mid-August. And it could even be like really early August or like the last day of July or something. It just depends on how much time they want to give they want to give people, and they want to give kind of like developers and everything like that to get their stuff ready and things like that. But also, you know, if it does happen earlier and everything goes well on Girly and we don't have any major issues or any merge related issues, and it pretty much goes how Sepolia went, like even as I mentioned last week, even though the Sepolia merge had those issues with the configuration stuff, like I don't think that's a mainnet showstopper at all. I think that we should just keep still pushing forward on that. Because once the issues were rectified, we went back up to like very high participation rates. So it wasn't really a big issue there. So I think that'll be fine. So if we do get like maybe a really early August kind of like Girly TTD time, or even just like early August generally, then we could still see the merge in mid-September, right? Like I know last week I said that I think it'd be more likely to be late September, but it depends on the Girly date. Like I think if Girly goes through early August, then, you know, 6 weeks from Girly to to mainnet, which brings us to about mid-September. So that would probably be plenty of time. I don't think you need more than 6 weeks. I mean, 8. That's a month and a half. You do 8 weeks. That ends up being 2 months of basically nothing happening. There could be and not nothing happening. There'll be shadow forks between Girly and mainnet. But really, you know, I don't think we need that long. So it could still happen in mid-September. But, I mean, at this stage, at this rate, I feel like September is pretty much a lock-in. Probably not early September, but like mid to late September is pretty much a lock-in. I'd put money on it at this stage. But obviously it depends how Girly goes. I don't expect there to be any issues with it since we haven't had any, like merge-related issues. Since we haven't had any merge-related issues on things like shadow forks, on Polynya on Ropsten. It was all either non-merge related or just config kind of like related stuff there. So definitely looking forward to seeing when the TTD gets announced for Girly. As I said, either on this week's consensus layer call, which I believe is maybe later in the week. I actually don't know what date that call is, or next Thursday, which is the AllCoreDevs call. So we'll have to see how that goes. But yeah, you can read this whole thread from Tim for a full breakdown of Friday's AllCoreDevs call. I'll link it in the YouTube description. All right, so last week, I think last Friday or Thursday's refuel, I was gushing a lot about DeFi and talking about how it's such a step up from what we're kind of like used to within the CeFi and traditional finance systems and all the reasons surrounding that. So I'm not going to rehash that here. But Andrew Keys actually put out a really interesting tweet over the weekend where he said, the fact that Celsius is paying back Aave, Compound, and Maker before humans should explain smart contracts to humanity. And then there's a follow-up comment here from Lewis who says, smart contracts are tough negotiators. And then Andrew says, there is no negotiation, which is really cool. So there are, like, I want to kind of like talk about this a little bit, but there are a couple of differences here. So the reason why Celsius is paying back Aave and Compound and Maker, well, I mean, there's a few reasons, but the one reason is like it's kind of like over collateralized, right? For them to borrow from these platforms, they had to put up collateral for it. There was no way about it. The protocol would not give them any money unless they put collateral up for it, right? So they had to put collateral there. Now, on the flip side, the protocol is not going to give them their collateral back until they pay their debt. And yes, some people can say, okay, well, what if the kind of like token holders got together in some of these systems like Aave or Compound and Maker that have on-chain governance and said, well, we'll just give the funds back to Celsius without them paying back their money. Why would they do that? Like, there's no incentive for them to do that at all. And to get to get that through and you have to kind of like convince not just like one person or one company, you have to convince a lot of people. It just wouldn't happen. So technically these sort of things can happen, it just wouldn't. And some of these protocols don't allow it to happen even technically, right? So because of that, Celsius knows this and like, wow, okay, the only way we're getting our collateral out of this system is if we pay down our debts. So they're prioritizing paying down their debts with DeFi over their debts with humans, because they know with humans, obviously humans can go down the route of kind of like suing Celsius or bringing them to court, criminal court or anything like that over what they've done and try to get the money out of them. But at the end of the day, like, there's no way for them to kind of like force them to do it. They have to go through third parties. Whereas with DeFi, there's no need for all of that. These protocols are just basically not even saying anything to Celsius. They don't know who Celsius is. The protocol doesn't know that Celsius is this kind of like this centralized platform that is having a lot of trouble. All the protocol knows is that this address put collateral into the protocol, that borrowed funds against it, and then per the rules of the protocol, this address needs to pay back that collateral, that kind of like debt. Actually, it doesn't have to be that address. You can actually have other ones paying back the debt, but the debt just needs to be paid back. And then the address that originally put the collateral in can take the collateral out, and if they pay all the debt off, they can take all their collateral back. That's it. No negotiations, no people in the mix of this, nothing. It's kind of like between Celsius and the protocol. And as I said, to the protocol, Celsius is just another user. It doesn't matter who it is. Like, the protocol doesn't differentiate because of the fact that the protocol is running on code that doesn't care about anything else except, I guess, like the collateral factors and things like that. Depending on the protocol, it's a bit different there. So that's why there is no negotiation yet, because there is no one to negotiate with. As I said, you could go to the governors of these protocols and say, hey, like, save us, bail us out. But that's just not going to happen, right? For a number of different reasons, just not going to happen. But some of these protocols don't even have the option of doing that. I mean, I think, I'm not sure about these ones specifically, but I think a lot of them don't really have that option, because it would just imbalance the system, and by doing so, it would just destroy the project altogether. Like, you could imagine a thing where there's this massive whale who doesn't pay back any of their debt, and then for some reason, the token holders come together of the protocol and say, okay, we're going to give this whale back their collateral without them paying back the debt. Well, that just leaves a massive hole in the system that needs to be paid back anyway. And across all users, right? So when you kind of like look at it like that, it just becomes basically near zero chance of something like that happening, even if it is technically possible to happen. So this, again, is another reason why DeFi has such a massive leg up over TradFi and CeFi, but there are some drawbacks here, obviously. The drawback is that this is only kind of like possible because of that over-collateralization, or just the collateralization aspect anyway. Let's use a real world example here. If you wanted to buy a house, you take out a mortgage, a home loan, right? Yeah, you have to borrow money from a bank usually, or some other financial institution, usually a bank. To do that, you're not collateralizing it with anything. Most like, especially if kind of like you don't have an existing house, you're not collateralizing it with equity. If you're a first home buyer, you just want a home loan. What you're collateralizing it with is your reputation, who you are, your identity. Obviously, you can't do that on chain right now. There are solutions that are going to be coming for that, but it's not an over-collateralized or even really a collateralized kind of loan. What it is basically you're putting a small deposit down, and then you're taking the rest out as kind of a small deposit on the house, and which, I mean, is not really kind of like collateral, right? And then you're taking a loan, and then you're buying the house, and then the house becomes the collateral that backs that loan that you've taken out. But through that process, like there's humans all the way. There's middlemen everywhere. There's laws and regulations and everything in there, and it gets very murky. Like the bank has to go through the legal system to take your house from you, right, as collateral. If you fail to kind of like pay the mortgage back. So it's different in that sense. Is that like you don't have to over collateralize for a home loan, for example. Whereas within DeFi, I don't think any protocol, except maybe something like a Maple Finance and a Goldfinch, I think there's only 2 or 3 of them, and they're not real. They don't really work the same way as Aave and Compound and Maker do, that will let you borrow without putting up, a collateral. And especially like you have to over collateralize as well, and you have to over collateralize usually by a lot. So the capital efficiency just isn't really there compared to the traditional system, but you do get all those other benefits, of course. Now, hopefully in the future, when we have more of these solutions online, like decentralized identity, and we have ways to lend capital out to, just people based on their reputation, and we can have relative certainty that they'll pay it back, or if they don't pay it back, there's a way to kind of like claw back those funds. We'll see how that plays out. But I think the fact that these things have to be over-collateralized before people can kind of like borrow from them, that is the most powerful thing here. And that obviously is not scalable to the world. It is not a credit system. It doesn't really give anyone any kind of like credit or anything like that. So what they do give is just the ability to collateralize and borrow against it, like a leverage position essentially. So leverage your existing assets to borrow against it. Whereas the kind of like the definition of credit is usually that you're given it based on like a credit score, which is based on your identity and reputation, right? Rather than based on something like as a collateral. But obviously in the case of a home loan, the house becomes the collateral that backs it up. But as I said, it's a different situation. It's not the same situation as having to put up the collateral first before you can borrow anything. In this instance, you borrow something, you buy something with it, and then that becomes the collateral, right? So it's basically like a leverage position, just with the fact that you don't have to put up collateral first to do it. The bank will just give you the money based on, I guess, obviously like your kind of like credit score and your employment status and kind of like things like that, and the rate will kind of like depend on various factors too. So I mean, that's kind of like the differences there. Now, hopefully I did a good explanation. I explained that correctly and properly, because it is kind of like getting into a bit of a murky territory there, with kind of like complexities between the two. But I thought this tweet was good from Andrew here. I kind of like just explained it very well, I think, in terms of the fact that Celsius is just forced to pay this back. Like there's no negotiations here. Whereas with their human counterparts who they owe money to, they can basically just put their lawyers in front of them and be like, talk to our lawyers. You'll get your money when you get your money, and they just keep delaying. Whereas with DeFi, with these protocols, the lawyers can't do shit. Like no one can do shit. It's like the protocols are telling Celsius essentially, you pay back your debt, or we're not giving you your collateral back. That's it. There's no negotiation, right? Which I think is pretty cool. But anyway, moving on from that, I think I spent a bit too long on that one there. So an interesting tweet from Polynya that I think maybe a lot of people will disagree with, but basically Polynya said. They quote by saying, rollups pay most of their transaction fees to L1, and rollups are bearish for L1 are both false. Application layer accrues most value. Execution layer, some value. L1 token as money used across execution and app layers accrues some. Data availability layer, very little. And then they continue with kind of like some follow-up tweets here. But also, I think Polynya said application layer, not application token, accrues the value. So some people got confused over that. Anyway, I want to spend a few minutes here breaking this down. So application layer accruing the value, not the token itself, means that kind of like obviously the applications accruing value in terms of like TVL, for example, or users or fee revenue to them. Doesn't mean it accrues to the token, but it still accrues to the application itself, right? There is value there. Like we've seen that obviously TVL is a very popular metric, if not, very flawed, still very popular, and it's used by a variety of people. Now, execution layers within the Ethereum context are layer 2s, right? There's like Optimism, Arbitrum, the ZKVM, stuff like that. They're kind of like the execution layers. Ethereum layer 1 is technically an execution layer as well, but long term we expect it to just be the settlement layer and for all these other execution layers, of course, through the modular roadmap. And then Polynya says, L1 token as money used across execution and app layers accrues some value. So I actually think that the sum value here should be like most value. I actually think that L1 tokens generally, most of them, if not all of them, I pretty much think all of them will only accrue value long term if they both become a money and a store of value. Now, there's a lot of different things that feed into that, and there's a lot of different things that can make something a money or a store of value. Just because something is used for payments doesn't really make it something that's going to accrue value. Yes, okay, it's a money, but there's a difference between kind of like money as a kind of like a payments thing and moneyness, and kind of like something like the US dollar, right? The US dollar doesn't gain value over time. It loses value against a lot of other things over time, but it is the best money in the world. Like it loses less value than all the other fiat currencies, especially in times like now, where it's rallying against others because of kind of like global macro consequences. So there's different kind of like definitions and different kind of like views there. And there's the store of value thing, which is pretty self-explanatory, right? You hold it, basically. You don't have to do anything with it. You just hold it, and you think and believe that this asset will either appreciate over time or hold its value over time against some other currency, against some other thing, usually fiat currencies. So for example, people say, gold is a good store of value because it both appreciates and holds its value and hold a stable value over time against the US dollar. And some people say, well, gold hasn't really increased in value for a long time now. And that's true, but it still can be considered a decent store of value because it hasn't lost its value relative to the US dollar as much as other things, right? So it kind of like holds its, it hasn't kind of like, I think I said that right. And it kind of like holds its value there. So it's all about purchasing power, as I've discussed before, and how different things hold value against each other. So that could be, something that becomes a store of value. And I think the only two stores of value really in crypto right now are BTC and ETH. I think BTC is a weak store of value, to be honest. I actually think its narrative around store of value is dying. And I've discussed this before, so I won't rehash it here. I think ETH is a very, very powerful money within the crypto ecosystem right now. It's used as obviously as money within the NFT ecosystem. It's used, its monetary properties gives it very good collateral properties, and it's used within DeFi. It's obviously used as a kind of like money, I guess like a money bond SOV hybrid with staking, right? And then obviously we have 1559 burning it as well, which kind of like adds to its deflationary properties, which adds to its store value properties as well. So those all come together to, I think, accrue most of the value to the layer 1 token. And for Ethereum, it's obviously very, very strong. And then Polynya's last point here about data availability accruing very little value. Now, I think the reason that this is actually true, and I agree with this, is because of the fact that data availability or data layers, they're going to be very, very abundant, right? They're going to grow faster than everything else. They're going to grow faster than execution layers. They're going to grow faster than settlement layers. They're going to grow faster than everything, simply because data is abundant. Hard drive, solid state drive, like all that kind of like space is abundant. But at the same time, it's more about kind of like where those data availability layers are. Like for example, Ethereum with dank sharding, that's an Ethereum data availability layer. But then you have Polygon Avail, you have Celestia, you have data layer. There's a kind of like standalone data availability layers. But still, they're not going to be able to accrue that much value because their growth in terms of capacity is probably going to end up outpacing the demand, at least for the foreseeable future. And if not just for the foreseeable future, maybe indefinitely. We don't know yet, and there are disagreements here between people I've spoken to about this, but still, like a standalone data availability layer logically really shouldn't accrue that much value to its native token because of the fact that there's so much space abundant. The fee revenue would be very, very low. The kind of like the token itself would not really take on any monetary moneyness properties or SOV properties because the layer is not being used as a kind of like a settlement layer. It's not being used as kind of like an execution layer or anything like that. It's being used purely for data. So this is just a pure data layers. Whereas Ethereum layer 1 is kind of like going to be a hybrid where it's got a data availability layer, but it also acts as a very, very strong settlement layer with the native token ETH being used in staking for all that kind of like settlement security and things like that as well. So that plays into that there. And I actually, replied to Polynya, I said, I don't think people understand that most of the value comes from moneyness uses SOV. Fee revenue on the L1 is an added bonus. Now, obviously, I've been very, very bullish and still remain bullish on EIP 1559 and burning of ETH. But if that existed in a vacuum, if ETH didn't have monetary properties, if ETH didn't have SOV, if none of that, if ETH was just being burnt and that's all we had to drive value to ETH would be worth way less than what it is today, just based on that. So when you kind of like look at it that way, I think it's just it's a bonus. It's a very, very good bonus, very, very strong bonus, especially over the long term, but it is not the main thing that drives value to L1 tokens. I truly believe the main thing is that moneyness and store of value, which comes from a lot of the utility built around these things. Like people say, oh, store of value doesn't have to have utility. It's like, no, it doesn't have to, but it's better that it does, right? It adds more value to the actual thing. It adds more value to the asset. So why not give it as much utility as possible? And I can't think of any other asset in crypto that has as much utility as ETH does. There is none. I don't believe there is any. I don't believe there is any that even come close to ETH's size in terms of liquidity and market cap and all that sorts of stuff. So taking all that together, I do agree with Polynya that, I guess like a half agree. I kind of like would say that the L1 token accrues most of the value, not just some. But I do agree with the kind of like broader points here. And I think that people often get the wrong idea about these sorts of things because they're not really used to thinking in monetary or moneyness and store of value terms. And they're kind of like, probably definition of store of value is probably not the right one. It's probably come from like the Bitcoiner camp, and I don't think there is any like right way to think about it. But the way I simply think about it is, okay, are people holding this asset with a belief that it is going to kind of like protect their capital, and not just protect their capital in terms of be able to make them more money and appreciate over time, but also just be able to not lose them purchasing power? Because obviously over the last 2 years, I guess, or 1 to 2 years, there's been high inflation in fiat currencies, which means purchasing power is going down for these things. So you obviously don't want to be holding cash for too long, but where else do you go? Like right now, it's actually quite hard. Like you don't want to be holding cash for too long because there's a lot of inflation, but also risk on assets, which is pretty much everything. Pretty much all assets at this point are going down, right? So you don't want to be in them either. So cash is like the least worst position to be right now, but that's going to change eventually. It's not always going to be like that. So if you're playing defensively, you're thinking, okay, where do I park my capital? A lot of people are parking it in ETH. There are still obviously people parking it in BTC. Some people are parking it in other kind of like cryptos. People still buying stocks. For every seller there's a buyer, guys. Like it's not like any of this stuff goes to zero. It's not Luna. I mean, Luna went to zero, but like, the most of it doesn't actually go to zero. So from that perspective, I think that that drives most of the value to the L1 tokens. And that's why BTC and ETH are so far ahead of every other L1 token because of the fact that the moneyness and SOV properties are so powerful. And as I said, I think BTC is actually losing those properties over time. I think ETH is gaining more of those properties. So that's why it's the one of the top reasons why I expect the flippening to happen eventually, because I don't see a path where BTC continues to grow its moneyness and SOV. Whereas I very clearly see the path for ETH, especially with the merge approaching. That's a huge catalyst, obviously, right? But the merge in a vacuum as well doesn't really do anything. It exists alongside everything else within Ethereum that drives the value here. But anyway, I'm going to leave that at that. Wow, I'm already at 23 minutes. I'm going to get through the rest of these. So Superphiz put out a tweet where he said, you think staking is hard. It's not. You could lose all of your ETH. You won't. You need powerful hardware. You don't. It requires constant maintenance. It doesn't. Only professionals should do it. This is flat wrong. Staking on Ethereum is meant for home users. We didn't spend so long developing a bleeding edge proof of stake protocol and probably the most decentralized proof of stake protocol in the ecosystem to let it be dominated by professionals and not cater to home users. It was literally built around catering to home users. That's why the kind of like Beacon chain is able to handle so many validators. And obviously, the 32 ETH requirement is not something that I guess like is accessible to a lot of people even at today's prices. But there is a lot of other accessible ways to stake, especially with things like Rocket Pool and other such services. But in terms of like the hardware and the software and just running it's relatively straightforward. The biggest barrier to entry is probably that 32th requirement if you wanted to be a solo staker. Now, there is actually a kind of like difference here between home stakers and solo stakers. You can be a home staker without being a solo staker because you can stake with something like Rocket Pool. So you don't have to have your 32 ETH or whatever. You can go stake with Rocket Pool and still run the software and still run the nodes on your own hardware. So there are kind of like ways around it. And there will be more in the future, hopefully, as well. But yeah, I thought this was just a great tweet from Superphiz. And he also linked to a bunch of different kind of like links, like lots of good resources here if you're interested in staking on your own, especially whether at home or at home as a solo staker. You should definitely check all of this out. I'll link it in the YouTube description for you to do so. All right, next thing just here from Superphiz as well was kind of like just some dates around the merge stuff. Obviously, everyone asking when merge. Ropsten merged June 8th. Sepolia merged July 6th. Both mergers were successful but had some human-introduced config issues that were solved quickly. Gurley isn't scheduled but may be scheduled during the July 14 call. There's the date. That's the consensus layer call date. So July 14, mainnet merge will follow shortly after Gurley. All right, so let's kind of like, since we've got a date now. July 14, Gurley TTD date gets announced. Let's say that happens, right? It gets announced for early August because, I mean, early August, right? All goes smoothly. Well, then I think mid to late September is locked in 100% at that point, if all goes smoothly on Gurley. Anyway, I'm not going to keep speculating there. I did talk about this just before, but that's the call to look out for. If it doesn't get discussed on that call, then obviously it'll be on the next Thursday's AllCoreDevs call. Then definitely it'll probably be later September then, but we'll have to see. How this goes. All right, so there was this interesting kind of like table here from this account on Twitter, Rez. And they said, it's been a while since the last time I had a look at on-chain volume. So basically, the key takeaways from this table is that only ETH or Ethereum and BSC do $50+ million in volume. Whales prefer to use Arbitrum instead of Optimism, both clearly ahead of Metis. Harmony, Moonbeam, and EVM-OS seem dead. Not all EVM chains are created equal, guys. Like, these are all EVM chains here. Not all of them are created equal. Most of them are literal, like, useless trash. Like, I'm just going to not sugarcoat it here. Ethereum, obviously the most dominant. BSC has surprised a lot of people. I've gone over this before. It has a very strong presence in Asia. Polygon, third. Shouldn't really surprise anyone here. Arbitrum and Optimism in 4th and 5th place there. And then Avalanche, Kronos, Phantom, I guess, like, trailing closely behind. But Phantom, everyone talked about that last year. It's pretty much dead now. Kronos, I don't hear anyone talking about this. I don't think that's kind of like long lasting. Avalanche has lost a lot of steam, right? It's already been overtaken by layer 2s on Ethereum, even though layer 2s came later. Arbitrum doesn't even have a token yet. Optimism obviously has a token, but hasn't really used it yet. And you can see like number of transactions, not just volume as well. So Arbitrum and Optimism has the same amount of kind of like transactions as Avalanche. Arbitrum has less, but I think that whales prefer to use Arbitrum as kind of like Rez says here. And then average transactions in dollars, you can see like kind of like what people prefer to use. And what I find hilarious about this is that Avalanche was kind of like going on about the fact that we got super cheap fees. We cater to like the people with like hardly any money or blah, blah, blah. I mean, the average transaction on Avalanche in dollars is $377. Like, that is, like, I mean, it's not huge, but, like, I think when kind of looking at these sorts of things, yes, it's good to have really, really cheap fees, but, like, if you're just an EVM chain, it's not really going to do anything, because the layer 2 EVM chains are going to just obliterate these things. Like, I'm so bearish on Avalanche. Like, I'm very, very bearish on the C chain on Avalanche, and the subnets just don't make any sense to me. Like, Ethereum and L2 is just going to absolutely destroy them, and it already pretty much has, right? And then all these other ones, like, they're just all garbage. Like, why do they, like, I don't want to bash them too much here, but, like, that doesn't make any sense that these things exist, especially, like, if they're a layer 2 on Ethereum, even a layer 2 on Ethereum, if like there aren't going to be that many successful ones. There's going to be a handful of them. So, like, when you look at it like that, it just boggles the mind that so many of these things kind of like are still around. They're still kicking in, and they're still supporters. But then when you really dive deep into it, you can kind of like guess why. It's because of the tokens, right? Anyway, I don't want to spend too long bashing there, but I thought this was an interesting table to just kind of like look at. All right, so another interesting set of stats here is from Michael, who works at Optimism Labs here. So this is basically a Dune Analytics dashboard that kind of shows a bunch of Optimism related transaction fees. And I think I've gone through this one before on the Refuel, but just like if you really are interested in looking at how Optimism is handling fees at both L2 and L1, this dashboard is for you. I'll link it in the YouTube description below, and you can go check that out. All right, so SudoAMM is now live. So SudoAMM is a new marketplace protocol that changes the way we think about NFT liquidity and trading. It is highly flexible, gas efficient, and fully on-chain. So another NFT marketplace, another decentralized NFT marketplace, and it is on-chain. So starting from when it went live, users can create pools that gradually buy or sell NFTs along price curves, provide liquidity to pools that buy and sell NFTs to earn fees, directly list their NFTs at fixed prices. LPs also have full control over their pool's pricing and can adjust at any time. So basically, it's an NFT trading protocol that does things a bit differently. It's not like your OpenSea or LooksRare. It is using a kind of like curve here to set the prices of kind of like NFTs and to get people bidding and buying and selling on these sorts of things with either a linear curve or exponential curve. You can see in this screenshot all the options that you have here to, I guess, like change the way we trade NFTs. I've been following this protocol for a little while now. It's been in the kind of like works for a little while. I think it's super interesting. I want to dive deeper into it. I didn't have a chance over the weekend to dive too deep into it, but you should definitely check it out and see what you like about it, what you don't like about it, and also join the Discord if you're interested in it. I think it's really cool that we're seeing more experiments within the NFT marketplace ecosystem, because I'm sick of seeing the same thing just forked and over and everything like that. Like, it's fine, but at the same time, I would love to see more experimentation, as I normally do in these kind of like things. So great to see that this is live. You can go check it out. I'll link it in the YouTube description. All right, so the Protocol Guild has a proposal to the Nouns DAO community. They'll be going live in 2 days for voting. So if you are part of Nouns and you want, well, I guess like Nouns DAO or kind of like the Nouns ecosystem, you can go and vote on this in, I think, 2 days from today. Yeah, 2 days from today. So this is the protocol this is a proposal for Nouns DAO to send funds to Protocol Guild, and I've talked about the Protocol Guild on the Refuel before, so I won't rehash that here. But you can read the proposal here if you want. I'll link it in the YouTube description below. It's basically wanting to raise, I guess, how much do they want to raise? Yeah, they want to get 500 ETH. Not a raise. They want to get like a 500 ETH donation, which is 2% of the Nouns DAO treasury, into Protocol Guild here. I think this shouldn't be contentious or shouldn't be something that's hard to get through. I'm pretty much thinking that this is going to go through without any fanfare. Like, I feel like Nouns DAO pretty much closely aligns with public goods. I've spoken to someone from there actually a little while ago, and I know a few of the Nouns kind of like whales, and they're definitely like public goods maximalist, and they're definitely all for this, I think. So I think this should pass, but yeah, really cool to see that Protocol Guild is probably going to get more funding here. All right, so last up here, Joseph from the Ethereum Foundation put out a kind of tweet saying, the Ethereum Foundation is looking for an ambitious software developer who can help build and develop an interactive website, working with designers and content creators to create a unique experience. So you can see the role here. It's a front-end developer at the Ethereum Foundation. Just wanted to highlight this for any of you front-end devs out there that want to work in crypto or want to obviously work in the Ethereum ecosystem. The Ethereum Foundation is one of the best places you can probably work. It's the closest you'll get to a lot of Ethereum-related stuff. So definitely go check this out if that fits into what you want to do. I'll link it in the YouTube description below, but I've gone over time, so that's going to be it for today. Thank you everyone for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give it a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. Thanks everyone.